All right, let's jump right in. Something pretty wild happened in the financial world back in July of 2025, a huge global rush into gold. But here's the thing, it wasn't just one simple story. It was actually a bunch of different stories all colliding at the same time. So let's unpack what was really going on. Okay, let's start with the big jaw-dropping number, $3.2 billion. That's how much cash flooded into gold-backed funds around the world in just 1 month. I mean, think about that. That's a massive amount of capital shifting into a single asset in just 30 days. Just wow. And you know, this wasn't just some flash in the pan, some 1-month blip. Nope. That huge surge actually put 2025 on track to be the second strongest year ever for gold investment. So you've got to ask, what exactly were all these investors buying? What's the engine behind this historic trend? The answer? It's all about gold ETFs. Now, if you're not familiar, an ETF, or exchange-traded fund, is pretty simple. Think of it like this. It's a fund that holds physical, real gold, but it trades on the stock market just like a regular stock. So you can buy and sell gold super easily without having to, figure out where to store a bunch of gold bars in your house. It's this easy access that's really fueling this whole modern gold rush. So, first things first, let's really wrap our heads around the scale of this thing. Because when you look at the global numbers, they are absolutely record-shattering. And look, it wasn't just about the new money pouring in. The total value of all these gold funds, what they call assets under management, it shot up to a new all-time high of $386 billion. That's a lot. And it means these funds were holding over 3,600 tons of actual physical gold. That's the most they've held since back in 2022. The whole market was just ballooning to a size we'd never seen before. Okay, so where was all this cash coming from, right? That big global number is impressive, but it's really just the tip of the iceberg. To get the real story, we need to break it down region by region. And we're going to start with the heavyweight champion, North America. So get this. North American funds sucked in $1.4 billion in July alone. And yeah, that's a huge number, but here's the twist. It was actually a slowdown from the months before. So what's going on here? Why was this part of the market cooling off, even a little, when everything else seemed to be on fire? Well, the World Gold Council has a pretty clear explanation. They point to a couple of key things happening in the economy. First, the US dollar got a bit stronger and interest rates were creeping up. That makes holding gold, which, remember, doesn't pay you any interest, a little less appealing. Plus, everyone's hopes for the Fed to cut interest rates kept getting pushed further and further into the future. That really changed the math for a lot of investors. And the story gets even more interesting. You had some investors in the US looking at the great run gold just had and thinking, you know what, time to cash in. They took their profits and jumped over to the stock market, which was having a nice little rally. People were feeling a bit more adventurous, a bit more willing to take on risks. So some of that safe haven money left gold and went chasing bigger returns in stocks. Okay, so let's hop across the pond to Europe. They also saw massive amounts of money going into gold. But this is where the story gets really juicy. It becomes a tale of two very different, sharply divided economies. We're talking about Europe's biggest players going in completely opposite directions. Just look at this. It's wild. On one hand, you have the UK seeing record-breaking amounts of money pour into gold. And right next door, you have Germany with huge amounts of money flowing out. Two economic giants right next to each other doing the complete opposite. The big question is, why? For the UK, it really came down to their own currency and their own economy. The British pound was taking a beating, and the economic numbers, well, they were looking pretty shaky. So for an investor in the UK, gold priced in their weaker pounds looked like an amazing deal. You add in a cooling job market, and what do you get? A classic run for the safety of gold. Germany, though, was the complete mirror image. What was happening there locally was pushing investors away from gold. See, German government bond yields were going up, partly because of big government spending plans. This created what economists call a higher opportunity cost. Basically, why would you hold on to gold, which pays you zero, when you can get a pretty decent return from a safe government bond? Throw in the idea that the European Central Bank might start getting tougher on inflation, and yeah, It's the perfect reason for German investors to decide to sell their gold. All right, if you thought Europe was complicated, wait till we get to Asia. The plot thickens for sure. The region as a whole saw a little bit of money come in, but when you look closer, the picture is just as fractured and complex as what we saw in Europe. It was all over the place. You had Japan and India still buying up gold like crazy, really strong demand there. But then you have China, the biggest economy in the region, totally bucking the trend. They were seeing big money leave gold. So, why was China selling gold? One word: confidence. Their local stock market, the CSI 300 index, was on a tear. It hit its highest level in almost a year. And just like we saw with some folks in the US, Chinese investors were looking at their booming stock market and thinking, that's where the real opportunity is. So they moved their money out of the safety of gold to chase those gains. Okay, let's take a breath here. We've got North America slowing down, Europe split right down the middle, and Asia going in 3 different directions at once. It's a lot. So let's zoom back out and try to connect the dots. What are the big global themes that are causing all these different local stories? It really boils down to 3 main drivers. First, you've got weak currencies. We saw it with the British pound. When your money's losing value, gold looks like a great way to protect yourself. Second, there's just general economic uncertainty. Things like trade tensions and worries about growth kept that safe haven demand going. And third, it's all about risk appetite. In places where the stock market was hot, like China and the US, investors were willing to take more risks. But in places with shakier economies, like the UK, they ran to the safety of gold. It's that simple. So if there's one thing to take away from all this, it's this. The Great Gold Rush of 2025 isn't one single story. You can't just look at that big global number and think you know what's going on. It's really a mosaic, right? A collection of very different local stories all playing out at once. If you really want to understand where gold is going, you have to pay attention to what's happening on the ground in London, Berlin, Beijing, and New York. And that leaves us with a really fascinating question for the future, doesn't it? As all these major economies keep going down different roads, some are booming, some are struggling, what does that mean for gold? Is its role as the world's #1 safe haven going to be challenged? Or does the fact that it can be so many different things to so many different people actually make it more important than ever? Now that's the story we'll be watching.